Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I wanted to do was talk about a question that I received from one of you guys pertaining to how inflation will affect real estate over the next 18 to 24 months. Now, there's been a lot of speculation out there about how asset prices are out of control and that we're going to have a correction here soon. But in today's video, I'm actually going to question that theory, and I'm going to lay out some of the reasons why I think that may not be the case in the immediate future. Now, before we dive into this video, I'd greatly appreciate if you can like and subscribe to this channel. It really helps with the YouTube algorithm, ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now that you've done that, go ahead and like and subscribe below. Now let's go ahead and dive right into this episode. All right, but now before we dive into this video and I explain to you why I think asset prices are likely going to continue to increase over the next 18 to 24 months, I want to add a disclaimer to this. I am not an economist. I just follow the market. I read articles. I draw my own conclusions based upon what I read. And as a result of those data points that I put into my brain, I believe this is going to be the case. Now, there may be other people out there that think otherwise, and that is completely fine. This is an opinion. It is not a fact. So I want to make sure that people understand that before they start writing in the comments about, oh, you know, what's going on with this and that and this and that. Again, this is going to be based on my personal opinion pertaining to what I think is going to happen over the next 18 to 24 months as it pertains to asset prices within commercial real estate. So the reason why I think that over the next 18 to 24 months, we're still going to see a significant uptick in property and asset values is for three reasons. Number one, inflation. As we probably already know, the federal government has been printing money like it's going out of style. I think I saw a statistic the other day that referenced that 40% of all the money in the supply right now has been printed in the last 24 months. So 40% of all the money that's ever been in circulation has been printed within the last 24 months. Now, what does that mean? It means that there's more dollars in the economy that are chasing a fixed number of assets, because we can't just print or create assets out of thin air, you know, as the federal government can when it comes to our currency. And so you're going to have a lot more dollars chasing a fixed number of assets. Now, what happens when that occurs? Asset prices begin to rise. Along with that, as you've probably already seen, the inflation rate when it comes to, you know, general products, there's a metric called the CPI, which is the Consumer Price Index, that follows a basket of goods and services within the economy and tries to determine what the perceived inflation rate is. Last month they released a statistic that said that it was an 8% year-over-year increase. Now, there's a lot of critics out there of the CPI that say that it doesn't track all the different metrics that you need to consider as it pertains to, you know, what the real inflation rate is. So realistically, the inflation rate is actually higher than 8%, more likely in the 10 to 12% range. So that means that if you were to earn $1 today and try to spend it next year, it'll be 12% less than it was the day that you earned it. So there's a lot of people out there that are scared about what's going to be happening with the money that they earn today. And so they're going to be trying to put it in places that are inflation hedges. And real estate tends to be a pretty strong inflation hedge in the economy. And so, you know, I think that that's naturally going to be a place that you're going to see a lot of people try to put their money. Number two is stock market volatility. I think we've seen over the last, 6 months or so, the stock market has been going crazy. It's up one day and then down the other. And when you start dealing with that on a regular basis, a lot of people start getting antsy about what that's going to look like. We've been in a bull market pretty much the last 10 to 12 years. And so people are starting to fear that there was likely going to be a recession. And it's not inflicted by COVID. This could be a recession that happens with the real estate cycle and the business cycle, I should say. So there's going to be a lot of people out there that are going to think, okay, well, you know, the market's due for a correction. Where can I put my money so that it's a little bit safer when it comes to, you know, not losing my shirt in the stock market? And real estate tends to be a pretty strong, investment in times where there's a lot of volatility within the stock market. And then finally, number three is supply chain constraints. This cannot be overlooked, although we are starting to see, supply lines starting to get back to normal. It's going to take us years to get back to where we were before. Because if you think about it, imagine that you have a string, right? And it's going along just fine. And all of a sudden, you compress the string because now there's a supply constraint. There's a little bump that occurs, right? It's going to take you a while, if you look at this rope, to level out the string again. So even if you get back to full production and full distribution, It's going to take you years to get back to normal when it comes to the wait times and whatever else. And you're starting to see that in construction costs. You're starting to see that in supplies that aren't available until months and months into the future. And so I think that there's going to be issues as far as construction of new product within the marketplace. And this is going to occur in multifamily, retail, industrial, all types of commercial property. And so you're still going to see a high demand to place money in these types of assets. You're going to have volatility in the stock market, which is going to drive people away from the stock market into more quote unquote perceived to be safer assets like real estate. And then you're going to have supply constraints, meaning that there's not going to be new product coming to market as readily as it has in the past. Therefore, demand's going to be high, supply is going to be low, asset prices are going to continue to increase. And I think this is going to be the case over the next 18 to 24 months. So if you aren't already buying commercial real estate, I would strongly encourage you to do so. Even if interest rates are going to go up, they're saying the Fed is going to be increasing interest rates. Obviously, that's going to affect people's purchasing power, but I don't think it's going to really impact demand as much as you may think because there's so much money out there chasing for assets. So I hope you gained some value from this video. Again, I create these videos on a weekly basis to share information pertaining to commercial real estate. If you like this video, go ahead and like and subscribe below. If you're in the Louisville metro area and you're looking to buy some of these commercial assets, feel free to reach out to me. I'm a commercial real estate agent in town. I'd be happy to help you identify some. Again, you can reach out to me via email at Raphael@CresantiGroup.com, or you can give me a call at 502-536-7315. Thanks again for tuning in, and we'll see you all next week.